Okay. Today's webinar is entitled Understanding Taxes for Woodland Stewards. We're really excited to be joined today by Nick Bullock, who is a tax specialist with Farm Credit East. Nick has been with Farm Credit East for over 13 years and has over 20 years of experience in tax preparation, including running a tax practice out of St. Johnsbury. So the way the presentation is going to work today, Nick is going to kick the session off with about a 15-20 minute overview, just around all the different tax considerations for woodland stewardship. And then after that, we're going to open the floor for questions and for discussion. And so again, at that point, you'll be welcome to ask questions in the chat box or raise your hand so that we can unmute you to be able to ask a question live. Okay, so we'll have plenty of time again for questions and conversation. So again, please don't hesitate to participate. And with that, Nick, I'm going to go ahead and hand it over to you to introduce yourself a little bit more thoroughly and get the conversation started.
Thank you. Nice to see everybody. Nice to be here. Thank you for having me to talk taxes about timber and land ownership. When we started to talk about this, I asked if I need to create some stuff to hand out to everybody, and they had a really great USDA handout that I'm going to speak to that covers quite a lot of great information. I think you're going to put that in the chat so they can get a hold of it. And it's kind of a good overview of some of the general stuff for land ownership and questions people have about taxes. I'm going to kind of start talking about how we acquire land, what we use it for, and then the income that comes from that, the expenses that come from that, and finally maybe talk about some credits and some long-term planning like that. This tax tips for forest landowners from the USDA, they got a lot of great things in there. It's a 4-page kind of overview. And it's chock full of some great information. So as it was said, my name is Nick Bullock. I'm with Farm Credit East. We are an ag lending co-op. We based out of Maine, New Hampshire, Vermont, New York, Connecticut, Massachusetts, and New Jersey. I'm located in White River Junction in Vermont. I've been with them for about 13 years. I've been doing taxes for a little over 20 years. So I've been around doing anything from small W-2s, 1040s to small businesses to large. I specialize now in partnerships and corporations and transitions of farm and generational transfers of businesses. Which is what I enjoy the most. So I won't get into the deep end, but we're going to focus today on talking about land ownership. And so one of the first things that comes up with land ownership is how do you get into the land ownership? So there's a couple ways of getting land and then having to make the decisions from there on out what you're doing with it. The first is that you buy land, right? So you can buy land that has, we use, let's say, $100,000 parcel, say 10, people want to talk about current use, which is a Vermont program. So we'll say it's a 50-acre parcel that we bought for $100,000. That's one way of acquiring land, right? And the other ways are to be gifted it or to inherit it. There's probably a fourth way that's just a combination of those three is, you can get in kind of maybe a partnership where you get like a profits interest where the land is transferred over to you by paying taxes on it. It's basically earning it, That's kind of another talk I give for the Land for Good people. So today we're kind of going to focus on buying it, inherited it, or being gifted the land. So, when we buy something, that's our basis in it. Now we use that for a lot of things from the tax standpoint. So in my example, that 50 acres that we bought for $100,000, that is what our cost basis is in it. If we want to do something with it, if we outright sell that land in say 10 more years and we sell for $200,000, I'll realize $100,000 capital gain from the sale of that land, which is that $200,000 less the cost of the land, which is $100,000. Now, there's things that can affect that basis. We can either add some of the expenses that we accrue over years to that basis, or we can improve that land, which would add to our basis, which would in turn reduce the net profit at the end. Very simple business like transaction. And the capital gains, today we're going to talk about two different types of tax. One's going to be the capital gains tax, and one's going to be ordinary income tax. So the difference between the two, we like the capital gains because it's the preferential tax treatment in our tax code. Depending where your taxable income lies, you can end up paying anywhere from 0 to 20 or more percent in capital gains rates. Ordinary income, the versus of that, is tax at the ordinary income tax rates that we have. And it can also, depending if you're materially participating in it, like in a Schedule C business, you can also have your self-employment income that can come into that. So it's a much higher tax rate than what capital gains rates can be at. So you'll hear a lot of people talk that the capital gains rates are the preferential tax rates in our code. Ordinary income, it depends where we have a marginal tax rate in the ordinary income. So it depends where your taxable income kind of ends up when you add up. I tell people it's like buckets. We fill up different buckets to get to the different taxable rates. So up to 10%, 15%, 18, 20, 22, that last dollar we pay tax in is what we end up calling our marginal tax rate. And we've just filled up the buckets depending on how much income we poured into the buckets. And those rates can change every year, depending what they do with the tax code. One of the things I love about what I do is that it's an ever shifting sand of regulations. So any given year, we can have more or less going on. So we've talked a little bit about how we acquire land. The first one is, we're buying it. That's straightforward. The other one would be it was gifted to us by somebody. So we're very fortunate. And my father gave me 10 acres, or I'm sorry, the 50 acres, so we can keep it in the example straightforward. My basis, if I bought it, would have been whatever I paid for it. But since I was gifted it, I have what's called a carryover basis. And it's basically whatever basis my dad paid for it. So if he paid $1 for land back in 1950 and he gave it to me, my basis would be $1. So if I sold that land down the road for $200,000, as opposed to my other example, I'd have a $199,000 gain to realize on my taxes. The third way is if we inherit it. Now, there's a really great provision in the tax code. Unfortunately, somebody has to die for it to happen. Is that when you inherit something, when somebody passes away and you inherit that property, you get it at the fair market value, whatever's today value is at the date of death. There's a 6-month variation in there that you can look in the code, but for the most part, it's the date of death and the fair market value. A lot of times we push people to get an appraisal of that done just to really hammer down values because it's a huge tax benefit. So in that example, if my dad bequeathed me that 50 acres and I went and sold it, say I was able to sell it relatively closely to him passing away, that $200,000 gain, well, the fair market value can be said, that's the fair market value of $200,000. That's what my basis was. So I have $200,000 tax-free clear. So to recap on basis, so when we purchase something, it's the purchase price plus whatever money we put into it. When it's gifted to us, it's whatever the person giving it to us, what their basis was in it. So it's important to get that number from them if that is the case. When we inherit something, we get the fair market value step up. And that's what you'll see reading in the code about it, is that step up in basis. So we get it to the fair market value of what it is at the date of death. So in our example, is that $200,000. So looking at the taxable event that happened in these three examples, we were all the way from $100,000 worth of capital gains when we bought it, almost close to $200,000 if we were given it. But if my dad bequested to me, if I inherited it when he passed away, there would be no taxable event. So it's very important to figure out what your basis is in the land you own. So now that we know what our basis is, what are we going to do with this property? And that kind of can happen, tell us what the tax treatment of any income or expenses that happen on that property going forward. So there's really another three ways of doing things. So you can have land that's for personal or hobby. You can own land for investment, or you can own land for and be in business of that land. And there's pros and cons for kind of all three of those ways. The most limited would be the personal use of the hobby. You don't really get any deductions, but typically there's not a lot of income associated with just owning land for a hobby or for personal use. So on my 50 acres, and on my example, I have a little cabin and my acreage up there. Any income that I incur from that, I would just pay. So if I sold my timber, got a $10,000 check, that would be capital gains or income on my personal tax return. And I just listed on my Schedule D or wherever I'm listing my other capital gains. There's a 8949 form out there. I'll try not to bore everybody with form names. So that's the most straightforward transaction. I've got no expenses. I had a forester come in. They logged it. And they gave me a $10,000 check on my tax return. I have a $10,000 capital gain, and life is very simple. Now, if I hold that property, that same 50 acres for investment, I've got no recreational. I'm not, I don't have a cabin up there. I'm not doing anything with it. It's strictly land I'm holding for investment for this. I'm letting other people do all the investment, the logging, the forestry, have a forestry plan. Typically, I push people when they come into my office that just buy land to have the forester actually do what's called a cruise of the land. So they actually know what they bought. So, we take that $100,000, 50 acres, and now we know how much wood timber is on that. Typically, they break it into pulp versus timber. There's lots of great reports that they do. I'm telling the wrong crowd. They're probably sitting out there, can correct me. So they're able to kind of give an estimate on what the value of the land is when I bought it. And we can kind of prorate that amount versus the purchase price. So if they tell us that there's $30,000 worth of timber and $30,000 worth of land, well, I bought it for $50,000. So I can't take 30-30. I've got 20-25 to kind of work with. We just use that percentage that we can kind of develop. So $25,000 is the basis of the land and $25,000 is the basis of the wood I'm selling. That comes into play down the road when I go to sell that timber. Any income that I get from that, I can take some of the basis. So if I sell all the timber, well, then I have that $25,000 basis that I can use. Typically, our foresters don't like it when we clear cut our land. So we have to prorate that $25,000 to whatever we sold in that. And that's going to be done. A lot of people ask me about the timber depletion, and that's really what we're getting at. So it's important when you buy a piece of land to have them kind of say, all right, what's my basis in that timber? And that's what I'm going to use to figure depletion down the road. And we do that on that Form T that everybody likes to ask me about when they own land. But you don't, to simplify your taxes, you don't always have to have that Form T in your taxes just because you sell land, you sell timber. You use that Form T for the IRS basically to claim depletion and that timber allowance. So it's something to be aware of. I'm not going to bore everybody with forms because there are thousands and thousands of forms out there. So we've talked about owning it for a hobby. We've touched on investment. The next would be a trade or business. So I actively manage my 50 acres. I bought it. I'm logging it. I'm cutting up the firewood. I have a firewood business that I'm running off of it. Well, this is a whole different way of approaching owning this land. I'm materially participating in it. Now, this triggers a lot of events at a tax level. You're basically in business. So we got some expenses that we're going to be able to take, which is great, accelerating a lot of those expenses. The flip side of that coin is we have a lot more taxes to pay. We're probably going to be subject to self-employment tax. All the income is going to be ordinary. Some of it could be capital. If I'm holding this timber and I hold it for more than 1 year, we can sell some of that timber and get capital gains treatment still because I'm holding it sort of for investments. It depends on what my business is. If I'm just in business to reap this timber and that's all I'm doing, it could be considered that is your inventory and it's still subject to self-employment income. But if it's a byproduct, I'm basically doing firewood processing and I'm taking some timber it's a business asset, but it's not what I'm in business to do. Some of that can get capital gains treatment. And like I said, that capital gains treatment is the preferential tax rate. The self-employment income, being able to claim all, the tractors that I buy and all my expenses from my firewood business, that's going to get onto that Schedule C or Schedule F on your tax return. And self-employment income is about that 15% plus whatever ordinary income tax rate you end up in. That can be anywhere from the 10 to 20 to 25%. So those are kind of the three broad scopes into what we can do in the tax treatment when it comes to land. So we have the hobby, we have the investment, and then we have the business. So when we sell standing timber, it definitely matters what our material participation is. A lot of farmers, because I do a lot of farm tax returns, they say that they sold some timber, but they're the ones that bought the skidder and they went out and they actually cut the trees down and drug it out. And they're thinking they're going to get that capital gains treatment, but unfortunately they did the work. So it pulls it back into their Schedule F, and it's just regular income to them in their everyday farm operation. It can be good business, but it doesn't get you that capital gains hands-off treatment. And that's what we're talking about with that material participation. You want to have it be passive kind of income to be an investment, right? So, being an investment in that middle column where a lot of landowners end up being, they would like to accelerate some of their expenses, but unfortunately that might not be the case. When we sell some timber, we can take some certain expenses on this spreadsheet. They have this really great handout that kind of lists out what you can kind of take for expenses on the sale of processed timber. Sale of standing timber. And it's, your basis is in the timber. So you figured out what your basis was. And we're going to take a little bit of that in the year of the sale. So we have that 50 acres that we bought for $50,000. We ended up finding that we have about $25,000 in basis in the timber. And then in year 3 or 4, we sell $10,000 worth of the timber. And then we have to kind of figure out how much our depletion was, how much of that $25,000 is attributable to that $10,000 of income. Typically, it's not going to wipe out that income, but it can definitely be a good deduction and is usually well worth having the forester do what they did to figure what that expense is. So, you're going to have the sale of the timber at, like, say, $10,000. We figure that of that $25,000 worth of basis, we got to take $5,000. And then we get to take, say, some of the expenses of the sale, the forester expenses, the attorney. There's a couple different expenses that you can take. So we have a $10,000 sale. We've taken some of the depletion. We've taken some of the expenses, and then we net that out. So say there's $1,000 of other expenses on top of that $5,000 of depletion. We have a $6,000 expense. So we have $10,000 sale, $6,000 expense, and a taxable event of $4,000 that would qualify for that capital gains treatment. I'm throwing a lot at people, and I'm trying to keep in our lanes. So we had the hobby, where I didn't have the forester do any of this. I just got a check from the logger, $10,000 capital gains on my taxes, nice and easy. Investment. We're keeping track of a lot more stuff, but we're still kind of hands off. We're not doing the work. We're having other people do it for us. So we're able to take some expenses, but not all the expenses. Whereas the third, we're in it for business, but it might not be our sole business. We're firewood processors, but we also sell some standing timber. So we can have that capital gains or ordinary subject to self-employment tax going on. Same piece of property, lots of different ways to slice it. I kind of went over, the timber basis, the sale of pre-cut. If we're doing the firewood processing, it can get us into, running a business and being material participation. We're kind of getting to the end of the tax part of that. One last tax that we need to mention about, when we have land for investment and we sell investment income, we can be subject to what's called the net investment income tax. It's another 3.8% that they can kind of tack on, depending where your income levels are at. Married filing jointly, you don't need to worry about it until I think $200,000 for single, $250,000 for married couples. So just watch out for your AGI. It can be an added expense, and a lot of times when you're holding these for investment, it can make quite a difference in what your decision making is. One of the other expenses that we have, there's qualified business income when you're doing your actual, when you're in it for profit and you're material participating, you can actually qualify as getting a qualified business income deduction. But you don't get that is if you're holding it for investment. So watch out for that. That can be a bit of a trip up. You get that 3.8 tax, but you don't get the QBI deduction, which can be quite a good deduction if you're in a profitable business. There's some credits out there. There's a reforestation tax incentive, which is kind of nice. So if you end up replanting, you can take up to about $10,000 of reforestation expenses in a given year. That can be either added to basis, or it can be direct costs that you can take in to offset any kind of income in that year. A lot of my investment people want to buy tractors to not do things on their investment property. That's when you're starting to cross the line into actually material participating. You got to take great expenses when you're material participating, because you're subject to self-employment income and ordinary income taxes. When you're holding a piece of property for investment, you're not doing the work. So you end up having to add those, say you bought a tractor, you can depreciate it, but it's going to be very slow. You can't, there's no accelerated depreciation to be taken on any of that. So it really depends on what you're doing with the property and how the income is recognized. On a hobby, I bought a tractor for my 50 acres, and it's a great thing to have. There's no tax deduction. The tax deductions for hobbies are definitely limited. They're an itemized deduction at best, but there's no itemized deductions until at least the end of 2025, subject to whatever they're doing with the tax laws. All right, I think I've covered quite a bit of this. Hopefully I'm not going too fast for anybody. A couple of the things on this sheet that they talk about is casualty and theft losses. So a big storm happens and it wipes out half of my timber on my investment piece of property. Depending if I have had the forester and really know what my basis is in all these, we can actually take maybe a casualty loss to offset any passive income that is on our tax returns. I would reach out to your tax preparer if you have that kind of issue go on. But it's important to know your basis. This is really what I'm driving home for everybody. That's your start point. And then what you do with the property from there on out can really change what direction the taxes go in. There's a couple things that you might be able to, with the USDA, there's cost sharing programs out there where you might be able to get some income. Now, sometimes depending on the program and what you do with the funds, typically they're going to be taxable. So when in doubt, it's taxable. if we can lump it into one of these, cost sharing, I got a $5,000 grant to repair some stream beds. And so the money came in, the work got done. I can reduce the income by the amount of the grant. Now, sometimes we can reduce the amount of the basis in the land, but that's really going to be specific on certain programs. So typically, I would say any money you get from these grants is going to be taxable, might be able to offset the cost of the program. Whether or not you can actually reduce the basis of the land is going to be a very specific kind of ordeal. They talk in this worksheet about conservation easements as well. Conservation easements are great, especially when you can donate it. A lot of times when we have a conservation easement, we can reduce the amount of that taxable event by what we have for basis in the land. But that depends on what you're doing and what that conservation easement is and is for. So it's more of on a per basis to take a look at that. If you're donating it, though, that can be quite a good deduction on a tax return, and there's a lot involved in one of those. So definitely reach out to your tax professional in that. When we go to sell a piece of property, if you don't want to pay taxes, there is a way to defer paying some tax on an investment piece of property. If you want to do, say, what used to be called a like kind of exchange, still like kind of exchange. They changed a lot of it. It really only pertains to land now. We used to use it a lot for a lot of things. That's definitely one you want to reach out to some professionals, because there's a process. Intermediaries have to hold the money. You can't actually get the money from the sale and reinvestment. And there's a whole process to actually defer income in a 1031 exchange. And that's for another talk, another day. Let me see. What other things do I have to talk about? They touch on forced carbon, which is going to be an exciting new realm for income for landowners. From what we can tell, generally going to be taxable. So depending on the nature of what you're holding the property as, it could be ordinary, but it could be capital gain. It depends on where they come down with that. They're really looking to come down with the latest IRS spec sheet that I saw is they were still trying to decide the life class to call carbon credits. So there's some great things to be determined, but I think at the moment, to be safe, it's taxable. If you're not materially participating, you sold your carbon credits and you got a check, you might be able to get away with putting that on a Schedule E and calling it passive income. And with that, I kind of gotten to the end of what I have prepared. I have some of the questions that people put out there. Everybody typically asks me about holding things in an LLC. Love an LLC at the state level, depending on your state. From a tax standpoint, a single member LLC is kind of the best, because if you create a multi-member LLC, you have a partnership tax return that can create a tax return that needs to be generated every year for you. And that can wipe out quite a lot of the profits from a small landholding. Just be wary. Limited liability companies are great for that purpose, is that they limit your liability. But from a tax standpoint, income is income. If you have a multi-member, it can complicate your situation, is basically what it comes down to. I talked a little bit about timber harvest and expenses reported to a taxpayer. Typically, you're going to get a 1099-S from from either the logger or the forestry company that's doing your work, and that can be, depending on how you're holding it, what the taxable treatment is in that. Let me see what other. A lot of people ask me about current use. Fortunately, I'm not a current use person. I do taxes. The current use is a kind of a Vermont state program that helps people offset the property tax burden. and their rules are vast and complicated. So best to reach out to. We were trying to come up with a person to reach out to for that. Typically, I have people call the actual current use people at the state of Vermont. They're the ones that know. They're the ones that make the decisions. I kind of went over the cost basis and capital gains for harvests. And then we had a question here. What elements of land ownership are tax deductible? Lots of them. Licensed forester to develop management. That's good. If you perform a TSI on your own and you're buying the equipment to TSI, you start to cross into that material participation. You might actually be materially participating in any income that you get could be more tax than you'd like it to be. So just be careful, and it comes down to facts and circumstances on each person's particular situation. One last one is somebody asked about a farm forest carbon program, 20-year contract. This is why I looked that up. Characterize the income. I would say it's ordinary income, but you might be able to get it on your Schedule E, and at least it's passive income, not subject to self-employment. But it all depends on how much material participation you have and with what you're doing.
Great. Thanks so much, Nick, for that great overview. Covered a lot of ground there. And just to remind folks, so Nick mentioned there in the chat box is that link to the U.S. Forest Service tax tips for forest landowners. So if you didn't catch it, that's what he's sort of been walking us through here. And so all that information that he just covered is included on that PDF in the chat box. So please don't forget to download that before we head off into the rest of our afternoon here. But we do have plenty of time for questions, and this is a great opportunity. We covered a lot of ground, and I know there's probably a lot of questions out there. So let's take advantage of Nick's time here, and please feel free to ask questions in the chat box, or again, if you want to ask a question live, I encourage folks, please feel free to put your camera on, raise your hand, or go ahead and unmute yourself and take advantage of our time together this afternoon to ask a question live.
I see Stephen asked a question. Maybe I wasn't clear. A farmer who buys a skidder and logs his own land can definitely take that skidder as a deduction. He's going to be in the business of forest management, as well as whatever farm operations. Whatever income he pulls off there is probably going to be ordinary self-employment income, but at least he can use that skidder to offset that income. So hopefully that clears it up for you, Stephen.
Great. And I've reposted that PDF in the chat box in case folks missed it. I had a question for you, Nick. So we've talked a lot about tax classifications. This might be a silly question, but what's required to, do you have to declare your classification, or is that, a conversation with your tax professional? Or is that something that, because I can imagine in some of these scenarios it may change. So what is the declaration process like for these classifications, tax classifications?
It comes down to the income that's coming in, isn't it? So if your income is regular and ordinary, you're going to want to offset that somehow. If it's sporadic and you log every 10 years and your hands off, and otherwise, then it's going to be that. So it's very case specific. Is it every year? Kind of, yeah. There's certain statements that you can put on your taxes each year saying, I want to capitalize these expenses into my land basis instead of taking them to offset something. But for the most part, you're going to have it's going to be depending on the income coming in and how you relate to it.
Yeah. Okay. That makes sense. We do have a question from Rick. Rick, I think I've unmuted you. Go ahead and ask your question. Well, I think you're actually still muted, Rick. There we go.
Nope. I just unmuted myself. Thank you.
I can hear you now.
So Nick, I see that I guess the title is enrolled agent, and I don't I'm not familiar with that term. I'm usually familiar with like a CPA or someone that has a kind of a formal education in accounting. I'm assuming that you're not an accountant by education, but
Well, I am.
oh, you are. Okay, wonderful. So,
So an
you,
enrolled agent is licensed to practice for the IRS.
okay, all right, terrific.
A
So you,
CPA is licensed at a state level to do auditing, and they do the same things. I focus in taxes. I don't get into auditing.
okay, all right, wonderful. So you mentioned a number of different types of ownership, and I didn't hear you mention trust. So is that something you're familiar with? And
Love a good trust.
I love a good trust. Okay, great. So how do um, so do you meet with clients? I mean, kind of how does someone get started with you? Kind of walk me through the process, and or do you know of other accountants in Vermont that do this, kind of have this expertise?
Sure. Well, that's great questions. Let me break it into two parts. Let me speak to trusts, and then I'll speak to the workings and all that. So there's a bunch of different trusts out there. So there's actually a trust can take in many different ways. Now, typically, a basic trust is going to be what's called a disregard, a revocable trust. A person sets up, they put their assets in, and they can control while they're alive. They can do what they want with it. Basically, it's disregarded. All the income flows to their own 1040. And when they pass away, all their assets go into that, and it becomes an irrevocable trust. It's kind of set in stone then, and then it's got its own reporting requirements, and it does its tax return and looks after the beneficiaries depending what it does. Now, a trust can get from there, which is the simplest form, to a very, very complex. You can get into complex foundations, many, many different beneficiaries. A lot of people set these trusts up to look after future generations with guaranteed income streams that come in. So a lot of times what we see people, a lot of times people set up family trusts to look after the land. So we put all the land in an irrevocable trust that the farmer or the agricultural people rent from the trust. And there's a lot of ways to work with trust. That starts getting into lawyer land, and I don't like to step into there. But when it comes to the tax side of things, we use trust for a very wide range of transferring assets to future generations. Working with me, I'm with Farm Credit East. We have offices all over New England. You can reach out to our website and say, hey, I'd like to work with you guys. We're a little full at the moment as far as workload, but we try to squeeze in anybody that we can. I'd have to reach out to my manager to really know where we're at with availability. But reach right out to the website. We're at farmcrediteast.org.com. And one of the people that's closest to you, that we have offices down in Middleborough and Bedford. But you can reach out to me directly. My email is nicholas.bullock@farmcrediteast.com.
Terrific. Thank you.
Great. And Nick, I'm putting the link, I'm trying to anyway, put the link to your website in the chat box. And I'll put in your email address here in just a second. Great. Looks like we have another question from Stephen about the Family Forest Carbon Program. You said that the income from it is taxable, but the income might not be as great as could be gleaned from logging. So what about opportunity costs associated with participating in the Forest Carbon Program? It cannot be logged if it needs to be left standing to absorb carbon. So the opportunity costs of not logging could be written off, question mark, against the carbon program income.
I'd be surprised if you could write off the opportunity cost. You'd have to be able to quantify and show that as an expense. You might be able to add it to basis, but I'd need to research farther about opportunity cost. That's risk. You usually can't write off risk.
Okay.
That's the insurance people.
Seems like more research is needed there, huh?
Yeah, it's a new place. So I mean, if you sign a contract for 20 years and that it needs to be there, you might not have the revenue from being able to log it, but you have. I'd more equate that to some of my rental people who have rental properties, and say that it was empty for 6 months. I want to write off that 6 months of rent that I didn't receive. Well, by not claiming it as income, that is the deduction. So you can't write off income that you didn't receive just because you didn't receive it, as an expense to offset other income. I hope that makes sense.
Yeah, interesting. Okay, great. Other questions? Again, feel free to, if folks have other questions, feel free to unmute yourself. And Stephen, if you want to ask, it looks like you had some follow-up questions too. There's another one in the chat. But encourage folks, if you want to ask questions of Nick, feel free to ask them live. It looks like there was a follow-up about conservation easements.
Yeah, if you sell it for less than the development value, well, you'd have to look at your basis. So you have a conservation easement. So I bought land for $100,000. If I sold it for $50,000, but they didn't give me a charitable donation on that difference between fair market value and what I sold it for, you have to work, depending on who you're working with. There could be that donation of that between the fair market value and what you were actually paid for. And so that fact sheet actually speaks to that on page 4. And it's a really good write-up of it. Would you be able to take it as a loss to offset other capital gains? I would say you wouldn't be able to. That's what the donation's there for. Typically, it's going to be what if you sold it for, if you bought it for $50,000 and you sold the whole, the conservation easement for only 45. Yeah, I don't know. I think you still have a donation going on.
Mm-hmm. Okay. Great. Thanks, Nick, for chatting through that. With a few more minutes here, again, if folks have questions, please feel free to put them in the chat. I have another question for you. So, you talk a little bit about timber basis, and I'm curious, what is your advice for like a new landowner? Do you, if somebody, going through those different scenarios, do you recommend if somebody has acquired land that they do a timber basis, or what in general, kind of what are some of the first steps that you recommend a new landowner take, when considering kind of tax liability and tax issues?
A lot of times what I ask people is what they're going to do with it. If all they're going to do with it is I'm holding it because I bought a camp and I'd like to write off some of the stuff. About the time they say I'd like to, I was like, well, is it enough to do? Talk to your forester. That's what you should do, because they're going to give you an estimate on, what it would cost to actually get those numbers and whether or not it's enough to justify down the road. Hopefully the good forestry practices would have a balance there. The more information that you can have about what you purchase, the better.
Yeah. And typically for that basis though, like, is that, the value that you purchased the land for, or is that kind of then there's also the timber basis, right? So I'm trying to are those combined or are they separate?
So I have my 50 acres. I bought it for $50,000. I didn't do anything.
Yeah.
So I have $50,000 worth of land basis. I would have to hire somebody to go out there and tell me if part of my land, when I bought it, was timber basis, and what that's got to be done by somebody that's qualified to do that. I can't just say $10,000.
Yeah. Okay. So that's a basis that's done by a consulting forester then. Got it.
So, as far as when it comes to that hobby style, I own my 50 acres, in 10 years I had, some of it logged and they wrote me a $10,000 check. I'm just reporting that full $10,000. I'm not trying to get any timber basis out of it. Now, when we hold something for investment, typically we're going to be a little bit more proactive about our investment. And yeah, we're going to get that forester. We're going to have a forestry plan. We're probably going to get it put into current use. We're managing that piece of property.
Yeah. Okay. Great. And it sounds like, I mean, with a lot of tax considerations for for folks to be working through. So I guess and I kind of following up on Rick's questions. It sounds to me like having knowing your tax professional, and having a relationship with somebody to kind of help landowners and woodland stewards work through all this is probably an advisable next step, right?
Yep.
Great. Okay. Well, Nick, thank you so much for your time. And
Pleasure.
we have another second if there are any other questions out there. But again, we covered a lot of ground today, and I do encourage folks who if you haven't downloaded that tax tip sheet in the chat box, again, a lot of the information that that Nick walked through today is included in that tax sheet. And one of the things that I think is interesting is that is actually updated by the Forest Service every year. And so the USDA Forest Service puts out a tax tip sheet every year because I think, Nick, as you mentioned, as we know, tax codes change. So that is a resource I think that folks should be aware of moving forward. That can be downloaded by going to the USDA Forest Service's website.
It's a really good one. It's well put together.
Yeah, great. Good. When I see a lot of comments coming into the chat box, folks really appreciate that resource. So again, with that, we'll go ahead and let folks get off into the rest of the afternoon. Thank you for everybody for joining us today. If you're a consulting forester and you're looking for credits, please feel free to put your name and email address in the chat box, and I'll follow up with a certificate for today's webinar. And then just a reminder, so on behalf of Vermont Woodlands Association, this is the first in our Winter Woodlands Nuts and Bolts of Woodland Stewardship webinar series. Next month in February, we'll be hearing from the NRCS team about all the different NRCS cost share programs that are available. So if you haven't seen that webinar announcement, again, we'll be blasting more announcements out, and I'll put a link in the chat box to that registration as well. So thanks everybody for joining us today and talking taxes. I think I appreciate, Nick, all of your expertise and really helping to kind of break this down for us. We covered a lot of ground, but it felt really digestible. So thank you so much for your time, and thank you everybody for participating today.